Hello, everybody. It's Jake Sensei, host Jake Gino Podcast, here with my co-host, the multifamily mentor, the coach, chef, the father, six, the best-selling author, the G-Daddy, Gino Barbo. Gino, how's it going?
Jake, I'm doing good. I just had a song pop into my mind as we were...
Bop?
No.
Bop. Okay.
And I know when you close a deal, you just get really anxious about the next one. And the song that popped into my mind is, you lost that love and feeling. I don't know why, it just did, because like you close a deal, you get so anxious and you're like, I'm done. I'm never going to do another deal again. I'm never going to feel that love ever again. But it comes back eventually, Jake. It'll come back.
Yeah, it's fleeting. I feel like it's never going to happen again. And so you always got to get on the hunt, but it's what it is, man. So anyways, Gino's getting a little romantico here. Today's guest is the founder of raisingcapital.com and Asym Capital. He is bringing over 10 years of experience in due diligence, underwriting, and capital raising for commercial real estate. He's also been featured in Forbes, Market Watch, and USA Today. So without further ado, Hunter Thompson from the top rope. Welcome to the show.
Honor to be on. Good to see you guys again.
I feel like we saw you in Charlotte maybe 15, 16 years ago. Now it feels like it's been a while. I know you've been on, but it's probably been even longer than that. So, why don't you just tell us, about the company over the last, say, 2-3 years and the evolution and the growth?
Yeah, for sure. So, I got into business in the wake of the Great Recession and was just lucky enough to, for lack of a better term, given market timing. You know what I'm saying? I've got to be humble about that because it's probably one of the best times in the history of the United States to start a commercial real estate business. But not just the market timing, I was able to get mentored by some amazing people that were able to weather that storm. So it wasn't just that I timed it right. It was that the only people that were left, especially in California, were people that were implementing, what now is considered syndicated investment opportunities, buying really quality deals in quality markets.
Was it Sam Freshman?
And I'm actually not familiar with who that is.
Oh, Gino, give him a history lesson here.
Well, it's interesting. Sam Freshman.
Oh, the author of the book.
Yeah.
Yes.
The red Bible.
The red book, the real Bible of real estate, right?
That's true.
And Hunter, I got to jump in real quick.
Gino, you got to tell us about the book a little bit before, so we're leaving people in the dark here.
Yeah, before I tell people about Sam Freshman, I love how you said, I was lucky. You weren't really lucky. What happened was you came in a specific time period. You took a big chance because everyone was running for the exits as they have been for the last 18 months. You stepped in very similar to myself. I met Jake in 2009. Nobody wanted to touch commercial real estate. Rents were $300. GDP was 1%. Interest rates were at 6% plus. It sucked. And everyone says, yeah, you should have bought back then. Well, nobody was buying because it sucked. But Sam Freshman, who is the author of an amazing thick-ass red book, talks about syndications. Two of his biggest mistakes, selling too quick and not buying enough. And if you guys want to read a book on syndication, he just tells it, simply, plainly, but he has so many amazing ideas. And he's actually, I think, a California guy, and he's done a lot of deals in California.
That's why I said it.
Yeah. And I think, Hunter, don't discount, the work that you had to put in to get it at that time, because there were many people who were burned by real estate and said, I'm never touching this again. So the fact that you jumped in, you laid the foundation. It's taken years. You need to build the foundation. So when the building starts going up, the next recession comes, it won't crumble the building. That's what most people fail to understand. And one last thing, if you're thinking about getting into real estate, now is the best time, as it was in 2008, because now the opportunities are starting to come. Don't wait till the opportunities come. It's too late, because a guy like Hunter has those relationships with brokers. They're going to send deals to Hunter and not to you.
I just want to say one thing before Hunter finishes his story here. I put a little bow tie in what Gino's saying. Everyone was running left. You were running right. So while you're being humble pie about this, you were doing the opposite of the crowd. And I think that's another component that you can't discount. But I'd love to hear more of the story.
You're so right.
Oh, thank you.
There's honestly some depth to that, because it's even harder than that, right? So like, let's say I'm a college kid at the time. I graduate. I didn't lose my shirt. Right. I didn't know, all my friends weren't going through terrible, bad things where they were running out of money. I was a college kid. So it was easier for me to do that. But now I know what it feels like to have a business and to see real estate correct dramatically. And when you look at that chart and you think, well, only an idiot wouldn't have bought, Number one, that idiot has listened to all their friends and family
Hindsight's
telling you,
2020. Yeah.
exactly. All your friends are saying, don't go into real estate, go get a real job, et cetera. But also you might be getting squeezed from liquidity.
Mm-hmm.
It's hard to do. And then lastly, and this is
No
what
one's
we're dealing
giving
with
money
right
at
now.
that time.
Totally. And lastly, no one wants to sell and no one wants to lend. So it's, as someone who's now not 25, but 38, I can kind of see why my young, hey, am I the only smart person that sees this? It's like, it's such a gift. But now that I'm older, I'm like, oh, now I'm starting to feel what it's like when you see an economic slowdown and people are
Ignorance is so bliss at the time too, right? Like,
exactly.
I was thinking about the other day when we got started. I'm just so thankful I was as young as I was and as stupid as I was, and I was willing to do the things that I probably would not be willing to do now, because it definitely we did some dumb shit. But anyways,
to piggyback off what you're saying, you were willing to do it because you're willing to get uncomfortable. And you're willing to say there's got to be something better, and I'm going to put in the time and the effort. Most people are just comfortable enough to not be uncomfortable. That's the problem. And Hunter, what you said, this is so important. Back in 08, and I think even now, it was hard to get debt. So Jake and I used a lot of creative financing, and it was hard to raise capital. Jake and we didn't raise capital earlier on. And now that's what you're seeing right now. So it sort of mirrors what happened in 08, 09 is what's going on right now.
Similar but different for sure, right?
Similar but different. And I think now there's more of a spotlight on real estate. There's a lot more competition than there was, but there's more tools now, and there's more ability to raise capital. It's a different environment. So as you're going through it and you're going through real estate, those early years, what mistakes did you make early on?
So it's hard to call it a mistake because it's like I really was paying attention, and the mentors I had, I feel like that was my Aleppo moment. If any but libertarians are out there, when someone says Sam Freshman, I go, who's that? But I am familiar with that author, and I did read his book early on. But I kind of saw that opportunity in 2008 as, how can I avoid that? And so my first true north was diversification. Now it's hard to say that it was a mistake, but if that's your true north,
diversification, in what sense?
Within the private sector, hey, let's get money out of the stock market. I don't want to be involved in this casino.
Gotcha.
I think that's a good true north. But then within the private world, it's like, okay, you've got your multifamily. All right, what else? All right, what else? And that was kind of my attitude at the beginning of my career. And I don't want to say chasing shiny objects, but it's like, now that I know a little bit more about investing, I don't know about building a business where the true north is diversification. I just don't know. And what you want becomes bigger and bigger, you start to learn more things about business that like specialization and vertical integration and hyper focus. Those are very advantageous, but are kind of against diversification. So then you start to have this conversation around, am I an LP investor or am I an owner operator? Am I a business owner? And so, those are the kinds of things where at the beginning of my career, I was thinking mobile home park, self-storage, office, industrial, what can I get my hands in? And then I would raise capital for other operators in various niches. And then in 2022, we made a pivot as a business to go all in on Phoenix multifamily. And it's been such a great shift, but I don't want to say that that was a mistake. It was just, that was the path that I took based on the information I had.
It's like I was kidding around saying it's been so long. The last time we spoke, I felt like you were all self-storage. And I could be wrong, but I was like, oh, I thought we were going to talk about self-storage today. So I'm out of the loop. And the reason I asked the question about diversification was because we look at diversification as A, B, and C class apartments. We'll have some of the workforce housing, and we have some newer built to rent, A class stuff. So that's, but I understand where you were going. You were saying, we're stock markets and things. Let's diversify this. But am I incorrect in saying that? Were you guys heavy into self-storage at one point?
Yeah, I mean, that was some of the first deals I did. And just for context, I wasn't trying to be a jack of all trades. I was trying to find best in class operators in various niches and partner with them as a capital partner, usually as a fund of funds. And later I had my series 82 and would raise capital under a broker dealer, if people are familiar with that terminology. So, and that's something that I did for years. But, the mobile home park business was the first industry where I was like, how am I the only one seeing this? I mean, the tenants own the homes, I'm sure a lot of people are familiar with that now, but at the time it was kind of nuanced. And then self-storage was another one of those where I just couldn't believe it. Like, they don't live there. The tenants don't live there. Like, how good can it be? And there was definitely some truth to that. And there were some great opportunities. Now, I'm not saying I played a role in it, But people figured those trades out from my perspective. And you see cap rates come down dramatically to where they're competing with multifamily.
That was everything in the last few years though too, right?
That's true. That's very true.
Yeah.
But in all fairness, at the beginning, the reason I was looking at mobile home parks is that there was a 400 basis point difference in cap rate. So now if it's like, well, listen, if everything's the same, I mean, goodness gracious, multifamily is head and shoulders above everything. Let's be real. That's what I always thought. It was just that the price was justified. So that's kind of my evolution as an investor. And that's what happened with the market.
What a beautiful story of an entrepreneur starting out, not knowing what he's going to do, and then pivoting and going through the journey and not trying to figure out in a day or a year, but it does take years, and not being afraid to pivot and not being afraid to understand, hey, this is what the market gives, but then ultimately saying, I've learned a lot in my career, but this is where I want to land. I want to land in Phoenix, and I want to land in multifamily. Now, why Phoenix? And maybe more specifically, just go into multifamily a little more. I heard cap rate compression. Maybe it's a basic human need. Maybe demographics look great going forward. What are your thoughts on that as well?
I mean, man, this is interesting because I know you guys are super bullish on multifamily, but I'll put it this way. I'm in a position to know because I've seen the ins and outs of some of the best syndicated businesses in the country of all different asset classes. And I'll just say some things that I think are not really up for debate. Number one, it's really competitive. Okay. So some people would say that's a red flag. Well, let me go on. The reason for that is that it is extremely lucrative. There are large enough assets that institutional buyers are attracted to it. It's still a simple enough investment vehicle that guys like us can understand it. People always need a place to live. There's endless demand. You can go on and on. But I think at the end of the day, it really comes down to this. The tradability of the asset is paramount to its success in the long term because it speaks to how many friends you have. And how many friends you have means how can you solve problems? You got a lot of friends in multifamily. If you start doing 8 connecting flights to get to your mobile home that's 50 minutes outside of whatever, you don't have any friends and you can get a 12% cap rate, but who are you going to get to renovate the asset? How are you going to get new tenants in there? What if you need a new home? You start to run out of friends quickly, especially when the market turns around. Because what happens is everything that's tertiary gets bid up and bid up and bid up. But when the market changes, everyone runs to safety. And so from my perspective, multifamily is like the bond market of the private equity. And you just always got a friend because of that.
Gino, let me make a few points to what he said there. It's more scalable than, say, mobile home parks and RV and I think to a certain degree self-storage as well, but it's also the credit worthiness of the residents. You can get a higher credit worthiness of a resident base than you can in mobile home parks. I think there's more stability as well. So those all lend itself to, if you're actually going to try to grow and scale a business, the ability to do it. Especially if you're a regional player. I think being a regional player with mobile home parks could get very challenging and burn out pretty quickly just due to the inventory that's probably there. So
yes, 100%. You can go on and on. But at the end of the day, the reason the debt is less expensive is because the institutions and the smartest people in the world, they view multifamily as a lower risky investment. And I think
much more predictable.
Play the game. Exactly. And the reason for that is just the number of participants and how savvy the participants are. So you might look at that and say, well, I don't want to be swimming with the sharks, but it's like these people have a lot to gain and a lot to lose. So they're just way more inclined to be more ethical. They're way more inclined to be straight shooters. You don't want to rely on that. But at the end of the day, it's like we're talking about savvy people standing to gain 7 and 8 figures. That attracts really quality talent. And I want to play the game where that's the outcome. That's the ideal outcome.
One more cherry, Gino. I just want to go on this because he's getting a bunch of things from our Monday morning meeting that we have. So if you look right now, and I'm going to speak specifically to our portfolio, the demand that was there in 2021 is not there, right? Meaning people coming in left and right, everything is rented. There's no way that there's an available unit. It's just crazy, right? I'd never seen it like that. But right now, if we look at our physical occupancy, it's just about 96% today. And so even though you're not seeing the kind of crazy demand, people are not moving as much, it's still a very stable basic human need. And I think that's why it gives agencies, institutions, so much confidence in it because look, people need a place to go, and it's not easy to put these things up. The time it takes to build and the shortage of housing in the country is a real thing. So I don't know. It's it might not be the hottest right now, but it's still hot.
But you both are speaking about larger assets. Let's not poo-poo the little guy.
No, I'm not.
No,
I'm
what
speaking
saying
about
is,
it all. Like
I
it
think
all. Yeah.
the 2 unit, the 5 unit,
Yeah.
the 10 unit, the 20 unit, where these institutions are not investing because it doesn't make sense. And the mom and pops right
Well, they
now
want
are
bigger
running the
dollars,
exits.
right?
Yeah, exactly. So
Yeah.
if you have a 30 unit asset that's going for $2 million, let's say, well, an institution is not really going to buy that, but the mom and pop can't buy. So there's so much opportunity in the space right now. And my next question, Hunter, is you're an amazing capital raiser. That's where you, I think, cut your teeth. People are saying to themselves, I can't get into multifamily. I don't have $800,000 for a down payment. Let's walk through a little bit of your capital raising, how you started out, and some of the skills that you learned to become a really good capital raiser.
Well, if people have read my book, I'll kind of be brief about this. I've just told the story a bunch. I'm sure a lot of your listeners are familiar with it. But 2014, I had invested in a couple deals passively, decided, hey, I'm going to partner with this mobile home park operator, and I'll do this through what's now called a fund-to-fund structure, where I basically said to the mobile home park operator, hey, if I show up with like a $500,000 investment versus a $50K investment, will you give me an 70-30 split versus a 60-40 split for this entity, essentially? And then I went to 30 people and said, hey, listen, I'm going to create an LLC. You can invest in this LLC and we'll just invest in this deal. I'm not saying I'm the man and I know all this, but I found someone who's pretty freaking good. And the only money that I'll make is just the difference that I negotiated with the sponsor. That'll flow through the LLC and that portion will flow to me. So you're getting the same deal if you had gone direct, but you're giving me credit for finding this opportunity and conducting due diligence, which I had and invested with them and all that stuff. And they said, okay, interested, let's hear it. And so I laid out this pitch for like 30 minutes and I had already promised the sponsor I would bring $500,000. And, I fell on my face basically and no one wanted to invest. So I was like, it didn't make any sense to me. I mean, it was producing 10%.
Sounds good in theory.
Month one. Totally. And I had to be super embarrassed. I texted this girl that I was trying to impress about my soon to be $1 million capital raise and had to be like, well, she asked me, Chrissy, my friend at the time, but now my wife, was like, how'd the capital raise go? I'm like, well, we didn't lose any money. Like, how could it go worse? It's $0. You know what I'm saying? So I basically learned this lesson that just because someone knows, likes, and trusts you, which those people do, that's a requirement, but there's so much more to it. They've got to be financially willing to invest. They've got to be emotionally bought in. They've got to have confidence in their own willingness to look at the deal and make a good decision. There's just so much more to it. And then for the last 10 or 15 years, I built a business around how can I do that in a way that is a one-to-many approach? How can I attract people to me that are getting nurtured and educated and going through that customer journey without me spending all my time just trying to force people across the finish line? And that's what I built my business doing, and went from struggling to raise $500,000 to I think I've raised close to $100 million now and placed money in investments all over the country and hundreds of millions of dollars of deals.
Hunter and the listeners, I'm going to put this into context. He didn't fail in 2014. Jake and I bought an asset, 136 units for $29,000 per unit. It was producing $450 a month in rents. We went to $595 day one. So if you think about it, that more asset was sitting on the market forever. We still own the asset. So to think about you not being able to raise a 10% cash on cash, their deals were out there. That was the minimum back then. And people weren't buying these assets because they were afraid. They just didn't.
That deal
not
sat
understand.
forever.
It was on the market for 3 years. It was on the market for 3 years, and it was just amazing. And people just didn't understand the value. Now, I love how you talk about the simplicity. So in raising capital, let's dive into a little bit deeper because I think it's important. I was at a winery called the Renault Winery this past weekend. And I think one of the most important things when you're raising capital is to keep it simple, depending on who you're speaking to, but also creating a story or a narrative about what you're trying to raise capital for. Like that mobile home park, I'm sure you didn't go in with a story about how you're just, being able to deliver affordable housing to people who can't afford it, and you're going to be able to deliver superior returns. Because I think most people, they just focus on IRR and cap rates, and you lose people. So let's dive into that a little bit. Did you refine your storytelling? Did you, how did you go from that $500,000 to over $100 million? What were some of the things that you did?
So Gino's speaking from experience, and it takes a really experienced and also confident capital raiser to be able to say what he just said, which is that the narrative or the story of the deal is what's going to sell the deal. And so when you're getting started, and maybe some of you are just getting started, to be honest with you, I was a bit insecure when I got started. So I try to come off as super buttoned up and dive right into the numbers. Oh, I'll show them I know the numbers, which I did. But the thing is, like, a random dentist isn't going around thinking like, I wonder if I could find like a 1.4x DSCR in Houston.
Yeah, you're becoming like off-putting to him, because how old were you at the time?
Well, I was 25 when I really started.
But the mobile home park deal, how old were you when you pitched that mobile home park deal that failed?
I think I was something close to that age, yeah.
So you're 25, you're wearing like a black suit, looking like the mafia, coming in, telling this dentist that you're the fucking hottest shit ever. And he's going, dude, you're just making me uncomfortable, man. Get away from me. This is like, I wanted to come here and have a glass of wine and hear about the deal. And like,
yeah,
I feel like
I'm friends with your mom.
This kid is pitching me, and I just want to go home now, right?
Right. And I didn't know anything about marketing. I just was a real estate person. That's what I was all in on. And so, but that's the truth. Like, sure, I can come and talk to you guys about DSCR, but like, what are the problems of the people you want to have invest with you? And how can you speak to their soul? Like, the reality is, maybe dentists or doctors, for example, they're thinking, dude, I've got carpal tunnel. I don't see a way out of this rat race. I made a bunch of money in my career, but I don't see a way where I'm going to retire. I've got no passive cash flow. That, to me, sounds like the hook that's going to get someone to actually pay attention. And if they go deep enough into diligence, they'll start to learn about things like DSCR. But it's like, hey, got a problem? Here's a ladder.
Yeah, what's the deal going to do for me?
Mm-hmm. Exactly. And so that first pitch was not a good version of that. But at the same time, like, you want to be also careful about where people are in their awareness. So a lot of us, like, we read Rich Dad, Poor Dad. We realized that our financial advisor had lied to us. We realized that there wasn't really a path to retiring at 65 if you relied on the 401k. This is stuff we had to come to ourselves. And so when you go to smush that 10-year customer journey that you went to, that started with Rich Dad, Poor Dad and ended with you at Jake and Gino for 3 years listening and just obsessing over these guys, you try to smush that into a 20-minute lunch, and people are like, you're just an evangelist for God knows
you're
what.
Freaking
you're
me out.
forcing this on me. You're freaking me out, bro. 100%.
Jake's freaked out a lot of people, by the way. He's got great experience with that, so he knows exactly what you're talking about.
I'm a A+ mentor at making people uncomfortable.
That's the trick, though. You know what? Can I just say one quick thing, though? That's the trick of it all, is because you have to be obsessed with this business to be good at it. So all you people that are just, holy crap, you're evangelists for real estate. You got to learn how to not only taper it back, but speak in a language that's maybe you a couple years ago when you were just flirting.
Find
with
the weave, he's saying, Gino.
Exactly.
Jake, let me jump in real quick before you make your point, because this is important as well. I'm sure when Hunter went to that meeting when he's 25 years old, he's the one who's speaking, and he's the one who's talking, and he's the one who's being braggadocious or a little bit more bravado, instead of being the Hunter asking, hey, Jake, how are things going? What are you trying to accomplish? Get to learn the person that you're trying to pitch. And it may not even be a good fit. And it's okay if it's not a good fit, but that person will respect you. And he may or she may even say to you, hey, I have somebody who wants to invest with you. So the first thing you need to do is you really need to get to know the person. And it's not a 20-minute lunch. It should take a little bit longer. If you're going to raise hundreds of thousands of dollars for somebody, get to know them. Get to see if they're a good fit with you. Get to educate them a little bit. And then you can offer them the opportunity. Don't do what Hunter did, and what Jake and I have done early on is, here's the deal. You want to invest. It's like, hold on a second. We haven't even dated yet. I don't even know you, and you're already trying to sell me something. That's the problem.
And he's got that thick cologne going, right? The Jaquois Noir, and it's just too much, man. It's too much.
You know what I'm saying? He just knows how to freak people out. Mr. Stenziano, as you were saying, I'm sorry.
No. So all I wanted to do is bookend the first deal, the mobile home park that failed. So you were, a little bit too know-it-all and everything, and maybe turning people off. Just why did you get zero investment dollars on that first deal? Was there any more to it? Because I think that the valuable thing for the listeners here is that they may be going into that first pitch. And if they can glean from your experience of where you failed, they may be able to not make that same mistake. So I just love to have you kind of wrap that up.
When you're an entrepreneur, you are kind of playing a no holds barred type of situation. You got to use what you have. And so I was very fortunate. I was from a family where I knew some rich people. I get 30 rich people in a room on my first pitch. The problem is none of them invested with me, but to say that it was a mistake, I had to try. It was the only people I knew. You know, it was the only
they had the
people I
money.
could get
Why
in.
not?
Exactly. So I wouldn't say that people shouldn't go and do it. It's just that when you talk to friends and family, you shouldn't use it as a ruler to determine how successful you'll be for two reasons. One, maybe they don't want to invest with you because they're totally not interested, not educated, don't trust you because you're friends and family. Or on the other side, maybe they're like, hey, you got some random rich uncle that's like, here's $100,000. And you're like, oh, I'm going to be rich because I'm going to now create a bunch of those people. Neither one of them are very helpful, but you got to try because getting that first deal is really difficult. But is that okay if I kind of stop? Because I mean, that's my honest answer. You got to go for it. So
well, you tried to raise from friends and family. They didn't have confidence in you at the time, and you came across as a little bit too arrogant. That's, if I can, summarize it, that's what I'm hearing from you.
Yes, but just be careful because the reason that I was arrogant was because I was insecure. I didn't want to come off as
you're
not
25 pitching doctors and dentists. Like,
exactly.
Duh, who's not going to be?
Fair enough. But just the note is, if you feel like you're going into one of these pitches and you're like, I really got to prove it, the way to prove it is to do what good salespeople do, which is to listen. And it's hard to do that when you're just trying to be like, everyone's going to think I don't know.
I got to show them how competent I am.
Yes.
Exactly.
I love that.
So the key takeaway is go in, understand your facts and figures, but be conversational and try to meet them where they are and find out what's important to them. And if they're a doctor that's attempting to retire, don't push DSCR, but attempt to show what the deal can do for them over time, maybe.
Here's my ultimate playbook for raising money when you're just getting started. I would go and put a bunch of people that you know in a Google form, rate them on a scale of 1 to 5 in terms of how in a position they are to invest, mostly financially. I would text them something like this. Hey, I've been looking at real estate deals for the past couple of years. Nothing's under contract right now, but would you be interested in staying in the loop if there is something? ? And then when you get some yeses, which you will, by the way, I would prompt them to book a call as soon as possible and basically show them an example deal that's not available because it's already fully subscribed. And I don't care if you still need to raise an extra $500,000. You start the call off by saying, hey, listen, just like to get you prepared, I can show you the last deal that we closed, the one that we're about to close right now. There's nothing available for it, so it doesn't really matter. It's just a way you can get accustomed to it so that next time you'll be more comfortable and ready to learn more. So just immediately their sales pressure is just off. It's not possible for you to invest.
Or even the last deal that we missed on, right? Say you haven't even done a deal yet, but you've been underwriting them and say, hey, we were outbid on this one because we're being conservative. We don't want to overpay or something. Everyone loves hearing that bullshit, right? But,
absolutely. Everyone loves hearing that.
Yeah.
But the key thing there is that if you turn that pressure off, now they realize that they're dealing with a professional. They're not in for this hour-and-a-half pitch. And now you can go to as much detail as you want because they know, as long as they're showing curiosity, you can go all around the rabbit hole. And by the way, I've done this exercise many times. And sometimes you can take someone from there's nothing under contract to here's an example deal that we're about to close to, we might be able to squeeze you into a $50K to $100K block. I mean, you can do that if you just simply turn it off. Now, some people say, well, you're kind of being misleading there. Fair enough. But it's more like you're trying to put it in a position where they're going to have a more comfortable experience. It's like dating. I didn't walk up to my wife at a club and be like, hey, you want to go halvese on a baby in 10 years? No.
But you did with your investors, though. You did with those first investors.
Yeah, exactly.
Go for it.
And no baby, right? No $500,000.
Let's go.
Gino, can I ask you a question?
You can. Yes. Just don't freak me out. I mean, you went from freaker to non-freaker. Let's not go back to freaker.
It's a little flattering. So when Gino and I were doing syndications, we would typically raise in 24 to 48 hours. So really, pretty quick, and we were very proud of that, right? But the funny thing is that I got 0 friends and family to invest. Hunter got 0 friends and family to invest. Gino, why were you able to bring the friends and family to the table and they invested in you? What are Hunter and I doing wrong? What was up with you? Because you were bringing in the familia here.
It's actually interesting. I think I started to identify as a multifamily investor. My family knew me as the pizza guy, but then they saw me leave the restaurant and they saw me have success. And Hunter, the one word that we all need to really focus on is scarcity. You're talking about scarcity. When you make something scarce and hard to get, people want it even more. And that sucks.
Not for me, they didn't.
It's unfortunate. Well, you show a little leg. I mean, listen, for me, I was just fortunate because my brother was all in on it. And they saw the wealth that I created for him. They saw the wealth that I created for myself. I love the asset.
You had a proven record with somebody close.
Jake, we had like 3 or 4. My family started coming to our events and they're like, well, this guy seems like he's the real deal. He's not a bunch of BS. If I had done this when we first launched, it may not have worked very well. Or they may have done a token investment just to try it out. And don't be deflated if they don't. And don't be deflated if they want to put their toe in the water and just try it, because put yourself in their shoes. If Jake's coming to me and he's my cousin and he's a pharmaceutical sales rep and all of a sudden he's telling me that he's doing real estate, I'm like, Jake, what are you trying to sell me, bro? And that's the reality. Put yourself in the other person's shoes. But Jake, I want to move on from the Drakkar wearing Hunter in 2014.
Drakkar on the wall.
Yeah. To 2021, 2022. And then all of a sudden he doesn't have a deal over the last year, but now he's got a deal on the contract. What's shifted in your mindset over the last 12 to 18 months where there was no opportunities? I mean, there's opportunities for others that weren't opportunities, but now all of a sudden you're seeing opportunities in the market.
Well, for context, so obviously in 2022, interest rates rose faster than they've risen in 40 years.
Mm-hmm.
And this created pretty significant distress in the multifamily space in several markets. And it actually created more distress, from my perspective, in more desirable, highly traded markets.
Yes.
And the reason for this is that to buy deals in your Tampas, in your Houstons, in your Dallas, in your Phoenix, you basically had to use floating rate debt if you wanted deals to pencil. Caveat, unless you had a ridiculously low cost of capital, meaning that it was standard to use floating rate debt. And so what ended up happening is that when interest rates rose, people were not underwriting for their debt service to double. So even if they were doing well from an operations standpoint, you just can't beat that in terms of debt service. Now, I'm trying to be, appropriate about this because, look, there's some really smart people that I respect that were really all in on the floating rate product at the wrong time. But for context, so were the best and most knowledgeable billionaire bond traders in the United States. So I just got to give a little bit of buffer because I don't want it to make it seem like, you're an idiot or you're not an idiot. This is just a market dynamic and sometimes these things happen. So having said all that, you see distress in a market like Phoenix where there's booming population growth, massive job growth, crazy supply and demand disequilibrium, and a huge demand for affordable housing, but then distressed sellers with their shirts on fire and their hair on fire. And I'm like, that's the green light I've been waiting for. And so my partner and I decided to stop doing everything else. He moved to Phoenix. And we're going all in when everyone's looking right. And we're having calls with experienced operators that are saying, oh, you're catching a falling knife in Phoenix and it's down and to the right. And we're like, oh, perfect. At least somebody thinks that. Because 3 years ago or 2 years ago, this was just the talk of the town. And we were never going to get deals to pencil back then. So he moves there. He tells his wife, I know you've spent your whole life living in Michigan. He's lived his whole life in Michigan. We're moving.
Well, that's an easy sell.
Exactly. And then we just start underwriting deals. And we're 50 deals of underwritten and we haven't seen anything, 100, 150, 200. And, I'm the guy that's on the more I'm like, let me get in there and make these numbers work. I just want to see what we have to tweak to make numbers work. And we look at it, it's like, we can't do this. It's like, it ain't happening. And I can't believe they paid that. But eventually a couple of deals started selling for more than we thought in a good way. And it brought other sellers to the market. And now things are starting to relax a bit. And so we have a deal that's under contract that's set to close. We'll probably be putting another deal under contract. And so we went from 200 deals underwritten, none, 2 under LOI, one that bounced out, that kind of thing, to probably going to close 2 deals in 1 quarter.
Mm-hmm. Before we go to the short answer questions, this last question for me, it's pretty important. How did you keep your composure? How did you not want to like jump off a bridge like Jake would if he didn't do a deal for a year and a half? Because that's really challenging because it's to get there right. It's like, I've got to do a deal. I've got a real business here. I've got to keep this going. But at the same time, no deal is better than a bad deal. How did you keep your composure and how did you keep that discipline?
Not easy. Because look, I'm a seasoned professional. We have a legitimate balance sheet, right? Now, in all fairness, we also have real employees and it's a serious thing that's going. It's a machine that's running. But like I was just thinking about like we have coaching clients where that's their first year in real estate. And it's like if we're struggling, I know people who are like just quit their job to do this are going to struggle. And so I just had to lead by example and be like, I know this is hard on you. It can play games in you. Maybe you want to force a deal across the finish line. And I've seen what happens when you do that and it's not worth it. Yeah, exactly. First quarter, right? So that's kind of the thing. I'm fortunate for that as well in terms of my experience and where I am now. But just going back to the comments around 2008, I think this is like similar to 2008, but way better because the data is just so clear this time. It's so specific to real estate. The overall economy is doing very well. Things were frozen in 2008. So I know what this story goes like in 5 years, and I want to be in the winning side of the equation. So we were patient and we still are patient, but it feels so good to just pick off a couple of these deals. And, even if you just do a couple, it could change your life.
The wait is worth it.
That's right.
It's just everything's moving so slow right now. I feel like there could become this sort of like pent up demand, and it's slow, and then like boom, the floodgates open. And I'm not saying that will happen, but there's just liquidity is moving slow right now. Money is just not transacting like it. Obviously, it was going at a rapid pace, 2 years ago, but it's just so slow right now. But anyways,
things
guys,
change.
Yeah.
Things change.
Oh, yeah.
It's always different. But there's a certain point where the data in real estate's so publicly available. It's no proprietary algorithm that Tyler and I have. It's that supply and demand is heading one direction. And so we know what's going to happen in 2025, 2026, 2027, 28. We have a very good understanding of what's going to come to market. We also have a very good understanding of what's going to be needed. And so by the time 2027 comes around, now it's, well, duh. It's the most obvious play of all time.
Yes.
Yeah. Phoenix multifamily or, Nashville, which I know you guys are bullish on, these types of markets like, duh. Well, that doesn't count. You bought in 2025. It's like, that's what I want to buy.
Yeah. Well, and here's the thing, guys. We're buy and hold investors, but majority of folks in real estate at some point plan to exit. So these things, will trade and it will speed up, and there will be this pent up, sales demand. So I'm interested to, see it happen again. But hey, let's take a quick time out here from our sponsor. Now, we have had a great run in multifamily, going from 0 units to over 250 million in assets. That's over 2,000 apartment deals that we've been able to purchase through our framework: buy right, manage right, and finance right.
Now, Jake and I, we created the Jake and Gino community back in 2015. We launched our first book, Build Our Profits. And since then, our students have closed over 60,000 units. That's over $4 billion in assets they've been able to close over the last 6 years.
And that's why this community has been so successful. We call it results-based education, and we pour back into the community everything that we've learned on our journey from 0 to 2,000 units and all our systems and scale that we use on our very own property management and investing companies.
Jake, I love that. It's not just education, it's implementation. So what I want you to do, click on that link down below, apply to work with our team, see how we can help you on your journey in multifamily.
All right, we are back. You've been kind of talking about your company a little bit, but again, sorry for my confusion about the storage units and things. But I'd love to hear about your business. And you brought the term vertical integration before. Are you guys self-managing? What does the portfolio of multifamily look like now? Just unpack that a little bit for us.
So we've done 9 transactions in Phoenix. Prior to making the pivot to buying deals directly, we did 6 transactions as like a capital partner, and now we're buying deals directly. I think that, the conversation regarding vertical integration, it's one that's up for debate in my view. I've got some really great mentors, like for example, Gelt, guys that I have a ton of respect for. They always use third-party management. I think that if you're going to go all in on one city, maybe that's something that you should consider. And that's our current vision. But there's property management groups in Phoenix that are just so good at what they do. I think the hybrid approach is probably our approach, where it's a really scrappy strategy, but we're highly integrated with the management. Obviously, my partner lives there. So like, they're not kind of squeaking anything by him, and he's seeing assets on a daily, weekly, monthly basis, et cetera. So that's kind of our current vision with that. I don't think it's worth the overhead personally, but that's just my personal thoughts. I got people that made a lot more money than me in this game that only do that. I also know a lot of people that never do that. And I think it's just kind of how you're.
Yeah, no, it's sort of how you're built, your preference, what you're comfortable with. So just to hear you, if I'm hearing you correctly, you may get there at some point, but not today. Is that right?
Yes, I think maybe if you buy 20 assets in a market, it's like, well, gosh, now it's not about making money. It's about controlling the whole experience.
Yeah.
But, where we are, I think being super scrappy and being very careful about fees, because that's just something an investor has to pay. I think that's kind of our current mentality, is just to be as scrappy as possible.
Yeah. And I think too, like for us, we're vertically integrated, but we're all essentially located within, a couple hour radius, all the assets. And the piece that I really love about it is the repositioning type stuff, the CapEx projects. We're doing all of because the two that I've really noticed that we've picked up over the last year, siding and decking. Now we have a good amount of like 80s product assets, and a lot of them have decks, right? And something has got to give. And the margins that these contractors are putting out there on decks these days, absolutely crazy, right? And so we've been working hard on that. I just think that the also some of the older stuff, the siding, looks like crap, and also the breezeways. We've been doing vinyl siding in all of our breezeways now, and it's just it's like a pride of ownership thing, but they're impossible to maintain. For those garden style units that have breezeways, and then the original developer put up sheetrock, it's impossible to maintain that at a reasonable standard if you care about your asset. If you want to get on site and tour a property and they put sheetrock in the breezeway, there's no way that you're going to be able to do that with sheetrock and be like, I'm glad I own this. I'm proud of this asset, and it's creating a great resident experience. It's impossible because it always gets turned to shit.
The other thing is just the control, right? You can fully manage those timelines and those budgets, and you can hold yourself accountable in a way that's not possible to a third-party firm. So for the listeners that are investors, it's a thankless job that Jake and Gino are doing that. But I think it's just an exercise in, taking it to the next rational step. How can I leave as little of my business to a third party, which I respect.
But it's real dollars though. At the end of the day, I mean, we are saving a lot of money by not subbing out these bigger jobs, and so it's not that you can't. It's not that you won't make money. It's just how do you choose to spend your time? Or you want to scale or sort of fine tune and go deeper on operations? Then there's no right answer there, right? It's depending on what your goals are. So we were talking about Sam Freshman before. Any book recommendations? Anything you've read in the last year or two that you want to get out there to the listeners?
I mean, I'd say broadly, Who Not How is a banger by Dan Sullivan. And the other one, which maybe you guys can remind me the name of, there's Who Not How, which is the one that everyone knows. The Gap and the Gain is another one that I feel that those two wrote again that I think is really great. Those are probably the books that recently have really shifted my perspective. I'll give you another one. Ready, Fire, Aim. Book about
I've seen it on Audible. I don't think I've read it.
Yeah, it's good. I'd also say The Hard Thing About Hard Things. Those are a couple like broad.
What is the hard thing about hard things?
It's about people that are basically credited to playing a role in inventing the internet and blowing up a business in a good way during the .com bubble, and then also keeping it going during the collapse. And it's just like, dude, I mean, I've had some challenging conversations with employees, but imagine firing 2,000 people. Like, you just learn lessons that it's difficult. Hopefully you can learn them through other people when they go through big booms and busts.
Yeah.
And the lessons you can take away from that.
That's the thing with the floating rate debt. You think about it and it's like, okay, well, if everyone's telling you that they can't raise rates, you start to believe that narrative, right? And then it's like, and here's the thing: people are throwing money at you. The only way to make the deal pencil or work is if you use this. So, it's one of those things where you just want to be able to sleep at night, and it's not that it hasn't worked countless times before. It's just a little bit rolling the dice there, when it comes to that. So
let me add one thing there, because I think we got to be fair here. So like, we've definitely done deals with floating rate debt. And like, I would consider myself a very savvy passive investor, because I've invested in quite a few deals. Like I've got 50K ones right now.
Dude, a lot of people were doing it. I'm not trying to sound like the biggest hater in the world.
Oh, no. I'm trying to give, you don't sound like that at all. But like, when hindsight is so powerful, like, let me put in perspective the conversation that I had when making that decision. Okay. As a passive investor that really knows his stuff. So yeah, I'm going to invest in this deal. It's a 10-year term. And okay, there's this thing called a rate cap, which now everyone knows, but back then no one knew, right? So how long is the rate cap? Well, it's 3 years. Okay, so we got a 5-year business plan, but we have 3 years of the rate cap. Well, how much is the rate cap? Oh, it's 30 grand. So you're telling me at the end of the 3 years, we got to buy something that's worth 30 grand? Well, that sounds like a no-brainer to me. It's worth the risk because the bank is valuing that insurance at $30,000. Now, I didn't expect that rates would go up so fast that $30,000 rate cap extension would be $500,000 by the time the 3 years expired. So it's like, in all fairness, like,
and then you're stuck. You're caught at that point. Yeah,
totally, of course, and it's difficult. But like, think about what that means. The banks, the institutions, the bond traders viewed the value of that insurance, aka the rate cap, at only $30,000, and they're off by a multiple of 20x by the time it was done. So you just got to be fair about these things. And I think that's the reason I speak like that, is that I'm trying to get myself in the habit of like recognizing that I don't have it all figured out. Because when you feel you do have it all figured out, that's when you really get blindsided without doing the math, without asking how much the rate cap is.
Hunter, I'm going to jump in here real quick before Jake wraps it up. I'd like to say that nobody has it figured out. We had the minds of the United States, the biggest minds, telling us inflation was transitory. And I'm here to be a hater right now. The administration that we have currently and the Fed screwed it up, because they should not have shocked the system. They played politics. They should have raised rates before the 2022 midterms. They didn't, because they wanted to win the House. And this is my opinion. And I think if you look back on history, it'll probably prove me right, because they knew inflation is not transitory when you pump the system with $6 trillion and everyone out there is trying to buy a used car and it costs $10,000 more today than it did yesterday to buy a used car, and lumber prices. It wasn't transitory. So if they had done their job properly and they had actually started raising rates slowly to slow the economy down, to be able to have this less liquidity, we wouldn't have this conversation of rate caps going from $30,000 to $500,000. That's the reality. Now, you can't change history. All you can do is look at it today, learn that lesson, and don't say to yourself, they can't do that. Rates can't go up that quick or cannot. Don't make those assumptions. Just tweak the business plan. And the next time you look at short-term bridge debt, just say, hey, what's worst case scenario? Because this is what happened in the last cycle. This is what may happen in the next cycle.
Fair point.
I don't want to sound like cliche, or how I was joking before about everyone says we're conservative or whatever, but I'm gonna be like a hypocrite right now, anyways, and say my biggest issue with all of it is price predictability, and that's why I've always been nervous about floating rate debt. Is just because you just don't know, and especially if you want to hold the asset. That's why it's always kind of made me nervous. And then going back to just managing expenses, because it wasn't just that. You had a lot of markets that boomed with taxes, okay? And a lot of people in Texas getting crunched because property taxes are a bitch, right? And then also insurance. So you had like this trifecta of just getting clobbered. And the only thing that was keeping things in place, I think, was the inflation of the rents. Right. So you had like this boom in rent. So it was, I think, enough for a lot of people just to hold on, but in this super uncomfortable way where everything's stagnant now, and capital's not moving, but they don't know what to do. Deals are not trading. There's a call for offers. The deals are not moving at the call for offers. Offers are not coming in, because I think a lot of people are aware of the situation a lot of these investors are in that are still holding these things, and they're looking for a 30% discount. And you're not seeing that happen either. And that's why you're in this very like stagnant environment. Some will break eventually. I don't know. Maybe Hunter's seeing the beginning of the crack in the ice here. I don't know. So something's got to give.
It will. And that stagnation, that's how and being difficult to raise money, that's how you know you're buying good deals. That's just all you need to know.
So Hunter, what's the best way for folks to get a hold of you, find out more about you and your business?
So we have a conference coming up that is in Phoenix, actually, and it's called Raise Fest, RAISEFEST. You can come check it out. We have a very cool trailer, by the way. If you don't cry during the trailer, then I'll owe you a Coke or something like that.
It's like these new Apple like AirBud things with the dads listening to the daughter's music kind of thing. One of those.
You know what? You go check it out and let me know, man. And then if you want to learn more about my company, it's raisingcapital.com. And then, of course, our private equity group is asymcapital.com. We have a special program for people who want to partner with us, kind of like I did when I started my career. And you can check that out at asymcapital.com.
Gino, you're back in Florida. You got the pastels going. I even see a little bit of a tan coming out. You got out of that North Country. You ready?
I am ready, Jake.
You step up to the plate?
In 2008, Hunter Thompson gets out of college and he latches onto a couple of real estate mentors. He's like, I like this real estate game. I see things that people don't see. We are in the depths of a recession right now. There's a lot of opportunity. While everyone's heading towards the exits, I'm going to go in and I'm going to dip my toe. And I'm looking at these amazing deals, mobile home parks, self-storage. And in 2014, going to do my first big raise, gonna knock it out of the park. Gonna walk in there wearing my cologne, being buttoned up. Gonna raise hundreds of thousands of dollars.
3-piece suit and some hair gel.
And I got a goose egg and I don't raise anything. And I'm saying to myself, what the hell did I do wrong? But you know what? I didn't quit. I figured this is where I want to be for the rest of my life. How am I going to learn and how am I going to get better? And you fast forward to where Hunter is right now. He's not only said to himself, you know what? I was doing great, but what I want to really focus on right now is Phoenix, and I want to focus on multifamily. He's really drilled it down. And if you really look at the story of an entrepreneur, that's what it's all about. You make enough mistakes, make enough money to pay for your mistakes. That's exactly what Hunter did early on. He learned from his mistakes, and then he was able to say, this is what I want to ultimately do, and this is where I want to ultimately be. And I think that's the story of a true entrepreneur, learning and having the vision and being able to say to himself, this is where I want to be.
Well said, Gino. I like Florida Gino more than New York Gino. I'm just going to say.
Bro, I love Florida Gino so much better too. No more grumpiness. I can't handle 20-degree weather. You like the Peter Millar? I mean, I got the Peter Millar back on. I got a little tan going on. I knew you'd see that. Thanks, brother.
You're there. All right, guys. As always, we believe in buying deals for the long term. Think in decades. I'm Jake. He is the Peter Millar G Daddy, and we make it happen. We'll see you next time.